What's up, YouTube? It's your boy Ty, and I'm very excited to bring you the first ever episode of How To Options. Today we're going to be going over some basic concepts and everything you need to know in order to get started in your options trading career. Alright guys, let's do it! Please like the video, please subscribe, and catch me every weekday after market close on the Smarter Gambling Show. Okay, so let's first go over the basic concepts. These concepts are the foundation and are fundamental to everything that we are going to be doing that is options trading. Options are a derivative of an underlying asset. And when I say underlying asset, I'm usually going to be talking about a stock. So, whenever I say underlying asset, you can assume that I'm talking about a stock. Calls and puts. There are two types of options contracts. There are calls and there are puts. I'm sure all of you have heard of calls and puts before. One contract is equivalent to 100 shares of stock. The strike price is the price you have chosen for your options contract. The expiration date is the day your options contract expires and the trade closes. In the money means the price of your underlying stock has moved past your strike price. Out of the money means that the price of your underlying stock has not moved past your strike price. Premium is the current value of your contract. It is the money paid upfront to buy options or the money collected for selling options. You may close your position at any time before the expiration date. Trading calls and puts. So when trading options, there are 4 different things you can do. You can buy calls, you can buy puts, you can sell calls, or you can sell puts. So first, let's talk about buying calls. When you are buying calls, this means that you are long or bullish on the stock. You want the stock to finish in the money by expiration. Buying puts. This means that you are short or bearish on the stock. You want the stock to finish in the money by expiration. So when buying options contracts, whether it's a call or a put, you want them to finish in the money by expiration. Okay, now let's talk about selling. Selling calls. This is when you are short or bearish on the stock. You want the stock to finish out of the money by expiration. Selling puts. This means you are long or bullish on the stock. You want the stock to finish out of the money by expiration. So let's just quickly recap. Buying calls is bullish. Selling puts is bullish. Selling calls is bearish. And buying puts is bearish. When you're buying options, you want them to finish in the money by expiration. And when you're selling options, you want your contracts to finish out of the money by expiration. Now let's go over the pros and cons. Pros and cons for buying options. It is good for speculation plays. It is much less expensive than investing in the underlying asset. It gives you more leverage on your trade. So, for example, let's say that you think that GME is going to $240 by January 21st, 2022. Now, GME is currently trading at $233. It would cost $23,300 to buy 100 shares of GME. Now, if we look at the options contract for GME at the $240 strike for January 21st, 2022, it only costs $9,430. So by buying this contract, you would be saving yourself $13,870 than if you just straight up bought 100 shares of GME. Buying options can generate large returns, theoretically infinite. The more your contract goes in the money, the more money you're gonna make. Now let's talk about cons for buying options. You must be correct about the strike price and the expiration date of your contract. If you are incorrect, the contract will expire worthless and you will lose 100% of your investment. So therefore, it is much more risky than just buying the underlying asset. Statistically, there is only a 20% success rate for people who buy options. Now let's talk about selling options. Let's start with the pros. There is guaranteed profit from collecting premiums. So it doesn't matter which way the trade goes, whether it's good or bad, you are going to collect your premiums no matter what. So as I just said, when you're buying options, there's a 20% success rate. On the other hand, when you're selling options, the contracts will expire most of the time worthless. So therefore, you will have an 80% success rate. Selling options will give you small but consistent gains. Now let's talk about the cons of selling options. Your profits are capped to the premiums collected. There's a large downside if the trade goes bad. But this is a little complicated because there are ways to mitigate your downside. So we're going to discuss this a little bit later on. Okay, now let's talk about intrinsic value, or IV, and extrinsic value, or EV. A contract's value or premium is made up of intrinsic and extrinsic value. Intrinsic value is the difference between the current price of an underlying asset and the strike price of the options contract. Example, an underlying asset with the $10 strike price is currently at $15. So you would have $5 of intrinsic value. 15 minus 10 gives you 5. Extrinsic value is the additional value of a contract beyond its intrinsic value. Example, your options contract is worth $100 and has $80 of intrinsic value. Therefore, it has $20 of extrinsic value. 100 minus 80 equals 20. There are many different factors considered when determining extrinsic value, such as time until expiration and volatility. More volatile stocks will have higher extrinsic value than stable stocks. Okay, now let's talk about what happens on expiration day. If you are a buyer and the contract finishes in the money, this is a winning trade. The profit depends on the current stock price, the strike price, or IV, intrinsic value, as we just discussed, and the amount paid for the premium. The formula is the difference in the current price and the strike price minus the premium paid times 100, because one contract equals 100 shares. Now, if you're the buyer and the contract finishes out of the money, this is a losing trade. The contracts will expire worthless, and the buyer has a 100% net loss. Now let's talk about if you're the seller. If you're the seller and the contracts finish in the money, this is a losing trade. The seller will keep the premiums and is exposed to the downside of the trade. Again, this gets a little bit complicated, so we'll discuss this in depth a little bit more later on. And if you're the seller and your contracts finish out of the money, this is a winning trade. The contracts expire worthless and the seller keeps the premiums. Okay, now let's talk about implied volatility, or IVR. This is not to be confused with intrinsic value, or IV, which we just discussed. IVR is a measure used to predict future movements in securities, or the underlying asset. Higher IVR results in the premiums of options contracts increasing. IVR increases in bearish markets and decreases in bullish markets. IVR does not suggest which way the market will move, it only suggests that there will be movement. The VIX is an index used to measure the market's overall IVR. So maybe you guys watch CNBC sometimes, they always talk about the VIX. A higher VIX is usually bad and a lower VIX is usually good for the overall market. It is a losing strategy to buy options with high IVR due to IV crush, and we'll discuss that concept a little bit later. It is a winning strategy to sell options with high IVR. So this is pretty straightforward. If IVR is higher, the cost of the options contract will go up. So therefore, if you're buying it, you're going to spend more money. Now, if you're selling it, you're going to make more money. Exercising versus closing positions. Option buyers have the right to exercise early if contracts are in the money. Exercising will allow buyers to buy for calls and sell for puts 100 shares per contract at the strike price. So while the buyers have the option to exercise, sellers are obligated to honor their contracts. Exercising takes all the intrinsic value but leaves the extrinsic value on the table. So therefore, closing out in the money positions are usually better than exercising them. So basically, if you're exercising early, you're going to lose some money because there's still extrinsic value in the contract, but you're giving that up when you exercise early. There are not many situations where exercising is better. The only two scenarios where it is around dividend time. So you want to exercise so you get the shares and you can collect a dividend, because you cannot collect dividend on options contracts. Or if the contract is very deep in the money, so therefore you can exercise and get the shares, and then you can sell the shares for the correct price that you want. And to close out options contracts are very simple. If you bought them, you just sell them back. If you sold them, you just buy them back. Same thing as with stocks. If you're long, you sell them back. And if you're short, you buy them back. Okay, now let's talk about rolling contracts. Rolling is when you want to adjust your options trades. Rolling up is bullish. You do this when you want to avoid assignment on a short call, or you want to increase bullishness for a long call. And to roll up, you close your existing position and you open up a new one with a higher strike price. Now the opposite of rolling up is rolling down. Rolling down is bearish. You do this when you want to avoid assignment on a short put, or you want to increase bearishness for a long put. And you do this by closing out your existing position and opening up a new one with a lower strike price. Then there's rolling forward. You do this when you want to maintain a position beyond the initial expiration of the contract. To do this, you close your existing position and you open a new one with a further expiration date. And you can combine rolling up or rolling down with rolling forward. So you can roll up and forward or roll down and forward. That is how to get started with trading options. In the next one, we'll talk about the Greeks. Thank you for watching this episode of How to Options. Please like the video, please subscribe, and catch me every weekday after market close on the Smarter Gambling Show. I will see you guys in the next one. Peace out.